Welcome to the deep dive. We're here to cut through all the noise and really deliver the crucial insights you need.
Help you get truly well-informed, basically.
Exactly. And today, we're embarking on what I think is a really fascinating exploration. We're looking into a true hospitality titan, Hilton Worldwide Holdings, Inc.
You'll know them by their ticker, HLT.
That's the one. Now, we've been handed, well, it's a comprehensive investment analysis, a whole stack of insights, data, financial reports. It's a lot.
It is, and our mission really is to distill that, find the most important nuggets for you, our listener.
Right. Whether you're, maybe planning your next vacation or perhaps considering an investment, or maybe you're just curious about how these huge global brands actually operate behind the scenes.
And what's genuinely fascinating here, I think, is how we can peel back the layers. Understand what truly makes a company like Hilton tick.
Not just from a travel perspective either.
No, definitely not. More from a strategic and financial viewpoint. When you consider an entity of this sheer scale, it's easy to get lost in the sheer volume of information.
Absolutely.
So our goal is to bring some clarity, look at their unique business model, maybe illuminate their competitive advantages, and sort of demystify the economic landscape they navigate.
Connect the dots so you can grasp that bigger picture.
Yeah, and hopefully have a few aha moments along the way.
We hope so. Think of this deep dive as your shortcut. Your way to understand not just a company, but really an entire industry that touches so many parts of our lives.
Travel, investment, the wider economy, it's all linked.
You'll definitely walk away with a richer understanding of what makes Hilton a standout player, or at least that's the plan.
Let's get into it.
Okay. Now, this is where, for me, it gets really interesting right from the start. Hilton, well, they are primarily in the business of owning hotels, not in the way you might think.
Now, that's a common misconception.
They've strategically built what this analysis calls an asset-light engine, which, okay, sounds a bit like jargon, doesn't it?
It does a bit.
So what does asset-light actually mean here, and why is it such a, powerful strategy for a company like Hilton?
It's not just powerful, it's almost a paradigm shift in hospitality, a real game changer. Asset light means Hilton acts mostly as a brand manager and a sophisticated operator.
Rather than a massive real estate owner.
Exactly. So instead of sinking huge amounts of capital into buying, building, maintaining the actual physical hotels, they use franchise and management agreements with third-party owners.
So someone else owns the building.
Right. Those owners put up the capital for the property itself, the bricks, the mortar, the land, and in return, Hilton licenses its powerful brand names.
Like Hilton or Hampton Inn or Waldorf Astoria.
All of them. And they provide the operational expertise, their global distribution systems, and critically, they tap into that enormous loyalty program.
So Hilton brings the brand, the know-how, the systems, the customers, but not the building itself.
Pretty much, they're the intellectual property owners, the brand stewards, the operations experts, but they don't carry the huge financial burden or, frankly, the operational headaches of the physical real estate.
That sounds incredibly robust. Ingenious, actually.
It is, and that ingenuity translates directly into some serious financial resilience. I mean, consider this. For the full year 2024, something like 95%.
95%.
Yeah, an astounding 95% of Hilton's adjusted EBITDA. And just quickly, adjusted EBITDA is basically a key measure of core operating profit before things like interest, taxes, depreciation.
The core profitability, essentially.
Right. Almost all of that came from these fee revenues generated through their management and franchise segments. This structure just dramatically minimizes Hilton's own capital investment in property.
So it insulates them from high fixed costs.
Yeah.
And all that ongoing CapEx, the spending on maintaining building.
Exactly. It shields them from those high fixed costs and the continuous capital expenditure needed for owning real estate. CapEx being, money spent to acquire, upgrade, maintain physical assets.
Okay, so these fees aren't just a nice bonus. They are the absolute bedrock of their financial model.
They are the bedrock.
And what makes them so predictable? You hear that word used a lot with Hilton.
Well, their predictability comes from the structure. These fees are typically a percentage of a hotel's gross revenues.
Revenue, not profit. That's key, isn't it?
It's a crucial distinction. It means Hilton gets paid its percentage even if an individual hotel's profit margins get squeezed, maybe by local costs going up, as long as guests are still checking in and spending money.
So top-line focused.
Right. It makes the cash flow streams from these fees remarkably durable and predictable. Much more stable than if Hilton's income was tied directly to the fluctuating operating profits of each hotel.
And that resilience must be especially valuable when the industry faces headwinds, right? Like moderating RevPAR growth.
Absolutely vital. RevPAR, revenue per available room, that's the big industry health metric, measuring occupancy and rates together. When that moderates, like we're seeing in some markets now, Hilton's model shines. It's designed for consistency. It helps them weather economic cycles much more effectively than asset-heavy competitors carrying all that real estate risk.
That makes a lot of sense.
Yeah.
But if they're not owning the hotels, how do they manage to cater to such, well, incredibly wide range of travelers? I mean,
Yeah.
you can stay in a pretty basic Hampton Inn or a super luxurious Waldorf Astoria. They feel like totally different worlds.
But they're both Hilton.
Exactly. How does that huge diversification work with this asset-light model?
And that's where their extensive brand portfolio architecture comes in. It's another cornerstone of their strength. Hilton strategically manages 24 distinct world-class brands.
24. Wow.
Yeah, and they are meticulously segmented, positioned to capture just about every type of traveler demand, across every price point, experience, lifestyle preference you can imagine.
Give us some examples.
Okay, so at one end, you have the absolute epitome of luxury and lifestyle. Think Waldorf Astoria, Conrad, LXR, catering to really high-end travelers seeking unique experiences.
Right, the top tier.
Then at the other end, you have powerhouse-focused service and mid-scale brands. Hampton Inn, Hilton Garden Inn, even their newer Spark by Hilton, which targets that premium economy segment. Essential comfort, accessible price.
That is quite the spectrum.
Yeah.
So how is that huge portfolio distributed, globally? And what does that distribution tell us about their underlying strategy?
Well, as of mid-2025, roughly, the global room portfolio broke down like this. About 4% in luxury, 27% in upper upscale, 29% in upscale, 34% in upper midscale, and another 4% in midscale.
Okay, so the bulk seems to be in that middle to upper middle ground, upscale, upper midscale.
Exactly, and that's strategic. If you look closely, that heavy concentration in upscale and upper midscale provides a remarkably stable demand base. It tends to perform pretty consistently across different economic cycles because it caters to a really broad mix of both leisure and business travelers.
But they're not ignoring the high end.
Oh, definitely not. It's not static. They are also aggressively expanding in those high-margin luxury and lifestyle categories. Importantly, through capital-light deals, aiming to grab a bigger share of affluent traveler spending and really bolster their premium image.
So diversification for stability, but also targeted growth in high-profit areas.
That's it. This meticulous diversification lets them mitigate specific market risks while still capitalizing on different opportunities globally, makes their overall revenue stream much more robust.
And when we talk about global presence, just how big is Hilton on the world stage? Are they truly a dominant force?
Oh, absolutely. Their global presence is formidable. It really speaks to their scale and reach. As of Q2 2025, their system had over 8,800 properties.
8,800.
Yeah, and roughly 1.3 million rooms, operating across an impressive 139 countries and territories.
Wow. How does that stack up against competitors?
Well, they currently rank third globally by room count, behind Marriott, which is number one, and the big China-based H World Group. But, and this is crucial, you have to look beyond just today's numbers.
Okay.
Our sources highlight that Hilton has one of the largest and, importantly, fastest-growing development pipelines in the entire industry.
Pipeline meaning hotels planned or under construction.
Exactly. It's not just a static number, it's a powerful signal of significant future market share gains. Continued expansion.
Is there any geographic concentration we should be aware of?
Yes, definitely. A key point for investors is that the business is heavily weighted towards the U.S. The United States accounted for about 75% of Hilton's adjusted EBITDA in 2023.
75%, so very sensitive to the U.S. economy.
Extremely sensitive, which can be a strength when the U.S. is doing well, but obviously a potential vulnerability if the U.S. economy slows down. But ultimately, that asset-light model, combined with the diverse brands and the vast global footprint, allows Hilton to mitigate many risks effectively while still growing aggressively.
Okay, so they've got this incredible range of brands, global reach, resilient model. What does this all mean, particularly for guests, and maybe more importantly for HOT owners looking to affiliate with a brand? You mentioned Hilton boasts over 226 million loyalty members.
Yeah, it's an astronomical number.
It really is. But how does that translate into a real competitive advantage? Beyond just, people booking repeat stays. What's the deeper insight there?
Well, this brings us to arguably Hilton's most potent competitive weapon, their moat, if you like. It's what the analysis calls the Hilton Honors flywheel.
The flywheel.
Yeah. That massive membership base, over 226 million as of Q2 2025, isn't just a vanity metric, it's the critical self-reinforcing engine driving the entire business forward. It creates this virtuous cycle that consistently generates value.
A flywheel, you called it. Can you
Yeah.
sort of unpack how this flywheel actually works? Why is it so fundamental?
Sure. So first, the sheer scale of this member base creates a proprietary and highly efficient demand channel. These 226 million members are actively incentivized, encouraged, through points and perks to book directly.
Through Hilton's own website or their app?
Exactly. And that distinction is incredibly vital because direct bookings are significantly more profitable for Hilton and its hotel owners than bookings coming through third-party online travel agencies, OTAs.
Like Expedia or Booking.com.
Precisely. Those platforms typically charge substantial commissions, often 15–30% of the room rate. Think about the direct cost saving on every single direct booking. It's a massive boost to profitability system-wide.
So it's not just about getting people to stay, it's about getting them to book in the most cost-effective way possible, maximizing the revenue for everyone involved.
Exactly. And the power of this loyal, engaged audience also translates into just superior revenue performance for the properties themselves. Hilton properties, leveraging the Honors Program, consistently achieve a remarkable 14% RevPR premium over non-branded hotels or competitor brands.
14% higher revenue per available room. That's significant.
It's huge. And it's as of mid-2025 data. It shows Hilton's mastery in demand generation. It's not just getting more bookings, it suggests they're getting higher value guests, consistently pulling more revenue per room.
So for a hotel owner, that's the pitch, right?
Yeah.
Hilton brings a revenue engine, not just a flag to put on the building.
That's exactly it. It makes affiliating with Hilton an almost irresistible proposition for prospective hotel owners. They get access to that 226 million member demand pool.
That's a huge incentive. It brings the demand and profitable demand directly to their door, reduces their marketing costs, boosts their top line. Sounds very symbiotic.
It absolutely is. And this is precisely why the loyalty program isn't just, a marketing asset or a nice perk for guests. It is the fundamental driver of Hilton's supply expansion.
Their growth in new hotels.
Yes, their net unit growth, or NUG, and consequently it drives their fee growth. This is the heart of that flywheel effect we talked about.
Explain that loop again.
Okay, so more members attract more potential hotel owners. Those owners are motivated to build or convert hotels under a Hilton brand to tap into that demand. More hotels create more capacity and choice.
Which attracts even more members into the Hilton Honors Program.
You got it. It's a continuous, powerful, self-reinforcing loop, builds momentum over time, and it's a massive, intangible asset.
Something not fully captured on the balance sheet.
Exactly. Its true economic value, the brand equity, the network effect isn't fully reflected there, but it's a critical, maybe even underestimated driver of their long-term success and competitive advantage.
Just think about that. 226 million people influencing where new hotels get built and ensuring existing ones thrive. That's a serious network effect, isn't it?
It really is.
It perfectly illustrates how a well-run loyalty program drives not just retention, but actual business expansion on shareholder value. Remarkable how those intangible assets can be the most valuable ones.
Absolutely.
But okay, even with such a powerful engine, this flywheel, the robust loyalty program, no company operates in a vacuum. The hospitality industry is, well, it's incredibly sensitive to external forces, macroeconomic trends. What's the current environment like for the industry overall? And how is Hilton responding to these broader currents?
You're absolutely right. External forces are always a factor. And the global hospitality industry has actually shifted quite dramatically. We've moved on from that revenge travel phase right after the pandemic.
Right, that surge of pent-up demand.
Yeah. We're now firmly in a phase of more stable, kind of normalized growth. Now, investor confidence is definitely recovering. Global hotel investment volume, for instance, is forecast to rise by a healthy 15–25% in 2025.
That sounds positive.
It is. But the top-line growth, the revenue growth, is definitely moderating from that really torrid post-lockdown pace. For example, industry forecasts for U.S. RevPAR growth in 2025, they're clustering in the low single digits.
Low single digits, like 1 or 2%.
Yeah, typically between 1.3% and 2.0%. And this reflects that more challenging macroeconomic backdrop. Persistent inflation, higher interest rates influencing consumer behavior and business investment.
So, less explosive growth, more of a steady, perhaps slower, hum. How's that affecting who is traveling and why? Is leisure still the big driver, or are we seeing shifts?
Exactly. We're seeing what some analysts call a great rebalancing of demand.
Hmm.
Leisure travel, which was the main engine of recovery right after the pandemic, that's expected to soften a bit.
Why is that?
Well, it's largely because consumer savings have been drawn down over the past couple of years. Plus, persistent inflation is still pressuring discretionary budgets. People are being a bit more careful.
Makes sense. So what's picking up the slack?
Business travel, especially for groups and large meetings, that's steadily recovering and is widely expected to be a primary source of demand growth for 2025.
Particularly in cities.
Exactly, particularly in urban markets that rely heavily on corporate and conference bookings. Now, international inbound travel to the U.S., that still lags pre-pandemic levels.
So potential future upside there.
Definitely potential upside. But that recovery could be hampered by things like the strong U.S. dollar makes travel here more expensive and just ongoing geopolitical uncertainty around the world.
So corporate and group travel, stepping up as leisure becomes maybe a bit more cautious. What about things like bleisure, that mix of business and leisure or workations? Is that still a big trend?
Oh, absolutely. And it's proving to be remarkably durable. It's really reshaping how people view travel, the blurring lines between work and leisure. That's creating sustained demand.
Especially for certain types of hotels.
Yes, especially for extended stay and lifestyle hotel segments. People are consciously tacking personal days onto business trips, extending stays, or taking longer workations, working remotely from somewhere new.
And that plays well into Hilton's diverse portfolio.
Incredibly well. They have brands specifically designed for longer stays and those vibrant lifestyle experiences. And, this touches on one of the FAQs we saw in the analysis, are earnings at a cyclical high or low?
Right. Where are we in the cycle?
Our analysis suggests Hilton's earnings are moderating from a recent cyclical peak, moving into a period of stabilization rather than indicating, rapid acceleration or hitting some kind of cyclical low point. It reflects the broader industry shift to more normalized growth patterns.
Okay, that's the demand side. But it's not just about who's traveling, is it? It's also about how many new hotels are being built. Is supply keeping up? Or are there constraints? And what does that mean for Hilton?
That's a critical dynamic. And interestingly, it actually creates a surprising benefit for established players like Hilton. There's a notable constraint on new hotel supply right now.
Really? Why?
Across many key markets, especially the U.S., you've got high construction costs, elevated financing rates because of interest rate hikes, and a tight labor market. Put it all together, and new ground-up hotel development is just economically challenging right now.
So fewer new hotels are opening.
Significantly fewer. In the U.S., for example, new supply growth is projected to average less than 1% annually over the next 3 years.
Less than 1%. How does that compare historically?
It's less than half the long-term historical average, which has typically been around 2% per year.
Wow. So less new supply. That means less competition for existing hotels and brands. Must be good news for Hilton and its owners.
Precisely. This environment of suppressed new supply growth creates a highly favorable backdrop for incumbents like Hilton. The scarcity of new rooms increases the value of existing hotel assets, and it fundamentally supports pricing power for established properties.
And does it affect how Hilton grows?
Yes, absolutely. What's even more beneficial for Hilton is that this dynamic makes hotel conversions much more attractive.
And conversions meaning rebranding an existing hotel.
Exactly. Taking an independent hotel or even a competitor-branded hotel and rebranding it as a Hilton brand. For owners, conversions are typically faster, less expensive in terms of upfront cash, and carry lower risk compared to building from scratch in this environment.
And Hilton is leaning into this.
Strategically capitalizing on it. They've launched conversion-friendly brands like Spark by Hilton, which offers a streamlined process. And they leverage the flexibility of their soft brands like DoubleTree, Curio Collection, Tapestry Collection.
The soft brands meaning they keep more of their original identity.
Right. They allow independent hotels to retain much of their unique character while still plugging into Hilton's powerful distribution and loyalty system. So, paradoxically, a challenging environment for new development actually strengthens Hilton's position. It boosts the market for conversions, which is a key and very efficient part of their net unit growth strategy.
Okay, let's unpack this from a financial perspective then. How has this asset-light, fee-based model actually translated into, dollars and cents on the bottom line?
Right.
And maybe more importantly for shareholders, with all the cash this model generates, what does Hilton actually do with it?
Yeah, the financial performance really shows the strength and resilience of the model in action. If you look at their top-line revenue trajectory, Hilton's total revenues grew strongly. from about $8.8 billion in 2022 to over $10.2 billion in 2023.
Solid growth.
Very solid. And even more telling, reflecting that asset-light strategy, is the growth in their core, high-margin management and franchise fees. Those rose from $2.6 billion to over $3 billion in the same period.
So the fee engine is humming. What about profit? Net income?
Well, net income, the bottom line profit after all expenses and taxes, did see a slight dip year over year in 2023. It went from $1.26 billion in 2022 down to $1.15 billion. But, and this is critical,
It wasn't the core business.
no. Our sources indicate it wasn't due to core operational weakness. It was primarily down to non-operational factors, things like higher interest expense on their debt and increased income tax provisions, not a fundamental softening of their underlying business profitability. The core engine remained robust.
That's a really important distinction. And what about more recent performance? How's the business doing today looking at the KPIs?
Yeah, digging into their key performance indicators gives a nuanced picture. 2023 finished strong. System-wide RevPAR was up 5.7% in Q4, driven significantly by a huge surge, like 41.6% in Asia-Pacific as travel restrictions finally eased there.
Okay, strong end to 23. What about more recently, say 2025?
In the second quarter of 2025, we did see a slight system-wide comparable RevPAR decline, down 0.5% year over year.
A decline. Why?
Management attributed this to softer trends in those really key markets, the US and China. Partially offset, though, by strength in the Middle East, Africa, and Asia-Pacific, excluding China. But here's the resilience highlight, and it speaks volumes about the model.
Okay.
Despite that slight top-line RevPAR softness, their adjusted EBITDA still grew a solid 10% year over year in Q2 2025, actually exceeded their own guidance.
Wow. So RevPAR is slightly down, but core profit up 10%.
Yeah.
How does that work?
It demonstrates how strong net unit growth in UG, adding new hotels, allows profit growth even when revenue at existing hotels is flat or slightly down. Adding new fee-generating properties boosts the overall EBITDA.
So it buffers them against RevPAR fluctuations.
Exactly. And it directly addresses that FAQ about whether earnings are driven by external macro conditions or Hilton's internal strategy. Clearly, it's both. But Hilton's internal asset-light model and that relentless NUG focus provide a significant, consistent internal growth engine that helps mitigate those external headwinds.
That is a powerful statement about the model's stability. They can grow the bottom line just by adding more flags to the map, even in a moderating environment.
Yeah.
Now, how CapEx hungry is this business? I assume not very, given the model.
You'd be absolutely correct. The asset-light model makes Hilton an extraordinarily efficient cash flow engine. Because those third-party owners fund the really capital-intensive parts building, major renovations, Hilton's own capital expenditure needs are remarkably minimal.
How minimal are we talking?
For 2025, they project their CapEx, their spending on physical assets, to be only $250 to $300 million.
Okay, compared to their cash flow.
To put that in perspective, that's only about 13–15% of their 2023 operating cash flow, which was nearly $2 billion. It just speaks to incredible capital efficiency.
So they generate a lot of free cash flow.
The business consistently generates strong free cash flow, FCF. That's the cash left after paying operating expenses and CapEx. FCF grew from $1.7 billion in 2023, projected to $1.8 billion or so in 2024. This means a very high conversion of earnings into actual cash.
With the vast majority available for what?
Well, primarily benefiting shareholders.
Okay, so they generate a ton of cash. They don't spend much on building or fixing hotels.
Yeah.
Where does it all go? What's Hilton's philosophy on returning value to its shareholders?
Their capital allocation framework is exceptionally clear and disciplined. Their primary objective is basically to return all excess cash flow to shareholders.
All of it.
Pretty much. With minimal internal funding needed for growth because of the asset-light structure, the vast majority of cash generated just gets funneled back to investors.
How do they do that? Dividends? Buybacks?
The centerpiece of the strategy is their aggressive share repurchase program. Buybacks.
How aggressive?
Well, in 2023 alone, Hilton repurchased an impressive $2.3 billion of its own stock. Through the first 7 months of 2025, they'd already returned $1.88 billion via buybacks and dividends combined.
And the plan for the full year 2025?
They project returning approximately $3.3 billion for the full year. And to underscore their commitment, the board authorized an additional $3.0 billion for repurchases back in November 2023.
So they're consistently buying back huge amounts of their own stock.
Exactly. This consistent reduction in the number of shares outstanding provides a significant non-operational tailwind to earnings per share, EPS, growth.
This directly answers that FAQ about whether they're issuing lots of new shares. Nope, the opposite is true. They're actively shrinking the share count.
Right. Fewer shares outstanding means each remaining share represents a bigger slice of the profit pie. Boosts CPS even if net income is flat. It's like an automatic benefit for investors.
It is a significant one.
And what about dividends? Do they pay those too? Yes, they do also maintain a regular quarterly dividend. For Q3 2025, it was $0.15 per share. It provides a direct cash return, but it's definitely a smaller component of their total capital return compared to the sheer scale of the buybacks.
So the buybacks are the main event.
They are. The key is the dividend policy is designed to be sustainable. A relatively low payout ratio, which preserves maximum financial capacity for those large-scale share repurchases. That remains their preferred method for returning value.
Okay, now this is where it gets really interesting for the long game, I think.
Mm-hmm.
With all this financial power, this proven asset-light model, the massive loyalty program, how exactly is Hilton planning to keep expanding its footprint and stay ahead of the curve? Because it's always a dynamic market out there.
Absolutely.
And what are the big risks they're facing that could potentially impede that growth?
Well, the primary engine of Hilton's future growth, the thing giving incredible visibility, is that robust and constantly expanding development pipeline we touched on earlier.
List of planned and under construction hotels.
Exactly. As of June 30, 2025, they boasted a record pipeline. 510,600 rooms across over 3,600 hotels.
500,000 rooms in the pipeline.
Yeah. It provides exceptional clarity into their growth trajectory for the next several years, and critically, nearly half of those rooms are already under construction.
Which means they're more likely to actually open.
Significantly increases the probability of completion, and therefore the likelihood they start generating those crucial fee revenues. This massive pipeline is what underpins management's strong confidence in delivering that 6.0% to 7.0% net unit growth, NUG, annually for the next several years.
So that growth is almost baked in, regardless of short-term RevPAR swings.
To a large extent, yes. It's a very clear and powerful growth path just from adding more hotels to the system.
Are they just building more of the same, though? Or are they adapting? What about strategic expansion, new segments, new brands, partnerships?
Oh, they're absolutely adapting and innovating. Not just adding more Hamptons, although they do plenty of that. They are actively pursuing strategic growth, especially in those high-margin luxury and lifestyle segments. And importantly, doing it through capital-light transactions that fit their core model.
Like what? Any recent examples?
Definitely. Big moves recently. In February 2024, they announced that exclusive partnership with Small Luxury Hotels of the World, SLH.
Ah, yes, I remember that.
Instantly added over 550 independent luxury hotels to Hilton's booking and loyalty platforms. A masterstroke, really instant capital-light expansion into a super desirable segment.
Without buying the hotel.
Exactly. Then, March 2024, they revealed plans to add the Graduate Hotels brand, known for those cool university-themed properties, accelerating their lifestyle expansion.
Another distinct need.
And in April 2024, they acquired a majority controlling interest in Seidel Group, that's the creator of the Nomad brand, specifically to expand that luxury lifestyle flag globally.
So very targeted moves into higher-end experiential segments.
Calculated moves. They allow Hilton to rapidly increase its presence in that attractive high-end market, significantly enhance Hilton honors for affluent travelers by giving them more luxury options, and add new fee streams with minimal capital investment from Hilton itself. Directly addresses that FAQ about significant acquisitions fitting the asset-light strategy.
They're clearly leveraging their brand power and loyalty program to expand smartly. What role does technology play in all this? Is it just bookings, or is it a deeper competitive edge?
Technology is undeniably a key pillar, both for enhancing the guest experience and strengthening their competitive moat. Hilton has invested heavily in its Hilton Honors app and related digital platforms,
Aiming for a seamless experience.
exactly, creating a seamless, personalized journey. Innovations like Digital Key, letting you bypass the front desk, unlock your room with your phone, Digital Key Share for multiple guests, connected room tech for controlling lights, temperature, TV via mobile. These are widely available now.
And the strategic purpose behind all that tech.
It's twofold. Primarily, it dramatically improves guest satisfaction, builds loyalty, makes stays more convenient, more personalized. But crucially, it also strongly encourages those direct bookings.
Pushing volume away from the expensive OTAs?
Precisely. improving profitability for both Hilton and its owners. And, on the management side, recent changes like Marissa Mayer nominated to the board, Kevin Osterhaus taking over global lifestyle brands, Misha Moylan as chief accounting and risk officer, these show ongoing strategic adaptation, keeping pace with evolving consumer behavior and tech trends, ensuring leadership is ready for the future of hospitality.
But even the best strategies hit headwinds,
Yeah.
right? The world is never static. What are the macro pressures, the operational hurdles that Hilton has to contend with, especially looking at, say, 2023 through 2025? It can't all be smooth sailing.
No, absolutely not. There are definitely significant headwinds and complexities. On the macro front, persistent inflation is still a factor. It puts upward pressure on operating costs for hotel owners. Things like wages, utilities, food costs keep rising.
And it affects guests, too.
Yes, that same inflation dampens consumer discretionary spending, can soften leisure demand, particularly for maybe middle-income travelers. Then you have elevated interest rates.
It's a double whammy there.
Kind of. They increase the cost of capital for developers, which can slow down new construction projects. And they also raise Hilton's own interest expense on its variable rate debt, hitting their net income.
So rising costs, higher borrowing expenses. What about operationally?
Yeah.
Challenges on the ground for the hotels.
Operationally, the labor market remains a significant, persistent challenge across the whole sector. Labor shortages, ongoing wage inflation, they continue to pressure operating margins for the hotel owners.
And if owners struggle?
If owners struggle with profitability, that could indirectly impact Hilton. They might become less able or willing to fund property improvements, maintain those crucial brand standards, or even commit to new developments. And of course, structural competition from platforms like Airbnb remains a factor.
Especially in certain segments.
Yeah, particularly in leisure and extended stay, where they offer a different kind of value proposition. Then there's geopolitical and regional risk.
Compared, they're so global.
Exactly. Hilton's vast footprint exposes it to localized economic downturns, geopolitical tensions. Management explicitly cited softer trends in the U.S. and China for that modest Q2 2025 rev pair dip. And given the U.S. contributes 75% of adjusted EBITDA,
Any significant U.S. slowdown is a material risk.
a very material risk.
Right.
And broader geopolitical tensions can always disrupt global travel patterns.
That's a comprehensive list of external factors. Are there any company-specific risks that stand out beyond the macro picture?
Definitely. That asset-light model, while a strength, creates a significant reliance on third-party owners. Their financial health, their operational performance is critical to Hilton's brand equity.
Because if a franchise cuts corners,
Right. If owners face financial distress, it could lead to failures in maintaining brand standards, maybe deferred property improvements, even contract terminations. Imagine a struggling franchisee letting a property look worn down that reflects badly on the Hilton brand, even if Hilton doesn't own it.
so they need to manage that relationship carefully.
Very carefully. That's why they have rigorous audits and support structures. Another big one, cybersecurity. As a tech-reliant global company, a major data breach reservations, Hilton Honors data could be devastating.
Financially and reputationally.
Huge financial liabilities, regulatory penalties like under GDPR, and severe damage to customer trust and brand loyalty. They also carry substantial debt over $10 billion, require significant cash flow for servicing, and has covenants that could limit flexibility under stress.
And operating everywhere means.
Navigating a complex web of global regulations,
Yeah.
labor laws, health and safety, data privacy, environmental rules, all complex, all can increase costs and legal risks.
That is quite the list of potential pitfalls. But stepping back for a moment, what about the ultimate risk for an investor? The risk of a total loss on an investment in Hilton. Is that a significant concern here?
Honestly, the risk of a total loss on an investment in Hilton is extremely low. This is a massive, globally recognized brand. It has a highly resilient, capital-light business model. It successfully navigated even the most severe disruption imaginable, the COVID-19 pandemic, which basically halted global travel.
They came through that surprisingly well.
They did. A catastrophic loss scenario would require something truly unprecedented and prolonged, like global travel fundamentally stopping for years on end. Highly improbable. The primary investment risk with Hilton isn't total loss, it's the cyclical nature of the industry.
Meaning periods of underperformance during downturns.
Exactly, like any cyclical business. But the company is absolutely built to endure and adapt.
Okay. Given all of this, the powerful model, the loyalty flywheel, the robust financials, the strategic growth, why does Hilton stock consistently trade at a premium compared to many of its peers? What does the market see that justifies this higher valuation?
That's a great question, and it's a consistent pattern. Hilton consistently commands a premium valuation. If you look at typical multiples like trailing 12-month price to earnings, PE,
Share price relative to earnings.
right. Hilton's TTM PE is around 41.3x. Compare that to Marriott at about 30.2x.
Quite a difference.
Or look at enterprise value to EBITDA. EBITDA, comparing total company value to core profit. Hilton trades around 29.3x versus Marriott's 19.8x. Again, a significant premium.
And you mentioned price to book isn't useful here.
Right. Because their aggressive share buybacks have actually resulted in a negative book value of equity, it makes the PB ratio irrelevant for valuation purposes.
So the market is demonstrably willing to pay more for Hilton. Why? What's the deep-seated reason for that investor confidence, that valuation premium?
There are several compelling justifications analysts and investors point to. First, it often comes down to what they call best-in-class execution. Hilton consistently delivers on its net unit growth targets, even in tough environments.
That's a predictable expansion.
Exactly. That NUG is seen as a high-quality, durable driver of future earnings. Less susceptible to short-term economic swings than RevPAR growth alone, investors value that consistency.
What else?
Second, that highly predictable and substantial capital return program. Primarily through those aggressive buybacks we discussed. It directly and consistently enhances EPS growth. That's exceptionally appealing to investors looking for reliable returns and capital efficiency.
So quality growth plus shareholder returns.
Pretty much. Investors appear willing to pay more for the perceived stability and resilience of Hilton's asset-light, fee-based model, combined with the clarity and consistency of its shareholder return policy. They view it as a very high-quality business, almost more like a brand licensing or tech platform business than a traditional asset-heavy hotel chain.
That certainly paints a picture of a company built for the long haul, with clear investor appeal. So what does all this mean for the future? As curious learners, what should we be watching for? What's the outlook?
Well, looking ahead, management's own guidance for the full fiscal year 2025 projects system-wide RevPAR growth between flat and plus 2.0%. So, acknowledging that moderating environment.
But the growth engine.
Crucially, net unit growth is expected to remain robust, between 6.0% and 7.0%. Adjusted EBITDA is projected between $3.65 billion and $3.71 billion.
And do analysts generally agree?
Analyst consensus is broadly aligned, forecasting revenue growth around 6.0%, EPS around $7.96 for 2025, and maybe climbing towards $9.04 for 2026.
And this outlook highlights a key point, doesn't it, about where the growth comes from?
It highlights a critical point for understanding Hilton's near-term trajectory. Almost all of their expected growth is anticipated to come from adding new fee-generating hotels to the system at NUG, not from significant pricing increases at existing hotels.
So the pipeline is paramount.
Absolutely paramount. The health of their development pipeline, the pace of new hotel openings, that's the central growth driver for the short to medium term.
So the pipeline is the main engine for the next few years. What could potentially make things better or worse than expected? Any catalysts or key monitoring points?
Sure. Potential catalysts for upside performance could include a faster than expected recovery in business and international travel that would boost those RevPAR forecasts. Successful integration of the new brands and partnerships, SLH, Nomad, Graduate, could also accelerate market penetration and fee growth.
And buybacks.
And of course, any acceleration of their already robust share repurchase program would further boost EPS. On the monitoring side, if you're watching Hilton,
What should you track?
keep an eye on whether they stay consistently on pace for that 6-7% annual NUG. Track how quickly rooms in that huge pipeline actually convert to hotel openings. Compare Hilton's RevPAR growth against peers like Marriott and Hyatt, look for outperformance. And maybe watch for any signs of margin compression at the individual hotel owner level.
Because that could signal distress and slow future development.
Exactly.
That's a fantastic roadmap for what to watch. And thinking longer term, beyond just the next few years, what's the overarching outlook?
Well, the long-term investment case for Hilton is really supported by some incredibly powerful secular trends, enduring trends that show no signs of stopping.
Such as?
Things like the enduring global demand for travel and experiences. That continues to grow as economies develop, disposable incomes rise. There's also the ongoing consolidation of the, frankly, fragmented hotel industry around major branded players like Hilton.
Because they offer better distribution and loyalty.
Superior distribution, powerful loyalty programs. And as we've discussed, the increasing importance of those loyalty programs and sophisticated digital platforms as competitive differentiators is only growing. Hilton's massive scale, its portfolio of leading brands, that huge loyalty program, It positions them exceptionally well to capitalize on these long-term trends.
And management incentives, are they aligned?
Yes, that was another FAQ. Management motivations appear strongly aligned with shareholders. Their pay-for-performance compensation is heavily tied to equity awards. Executives, including CEO Chris Nassetta, who owns over 3.5 million shares, valued at over $960 million last we checked, have significant personal skin in the game. Their incentives are very much tied to long-term value creation for shareholders.
Okay, wow. We have definitely unpacked quite a bit today.
We certainly have.
From Hilton's really unique, remarkably resilient asset-light business model to that powerful, self-reinforcing flywheel of its loyalty program and how they navigate the complexities of the global travel market. We've really seen how a hospitality giant doesn't just survive, but truly thrives.
It's fascinating to see the layers.
It really is. How many intricate layers there are and how interconnected all these seemingly disparate parts of the business are, all working together to create such a durable, cash-generating enterprise.
You know, this deep dive certainly raises an important question, doesn't it? As the world keeps evolving, especially with those blurring lines between work and travel becoming more entrenched, and that ongoing push for seamless, hyper-personalized digital experiences.
How do they adapt?
Yeah. How will companies like Hilton continue to balance their massive global scale with providing truly unique, personalized experiences for every single guest? And maybe more broadly, how do we, as savvy consumers, as curious learners, benefit from these deeply entrenched, interconnected business models that define so much of our economy, especially as they adapt to our own changing habits and desires?
Absolutely. It is a dynamic landscape full of evolving consumer expectations. We really hope this deep dive has given you a much clearer, more nuanced picture of Hilton Worldwide Holdings, Inc. and the powerful forces shaping the global hospitality industry.
Hope it was useful food for thought.
Definitely. Until next time, keep that curiosity alive.